man, entrepreneurs, welcome everybody to Economic, all about economics and finance. So thanks to all subscribers, and here we go again. As the chancellor of the day went to the dispatch box, the yield curve, the gilts yield curve went haywire. And what a ride! So the UK cost of borrowing, the gilts, and UK cost of borrowing has surged in the past few days by almost 0.3%. You would say, okay, it's a minimal thing. No, it's not really a minimal thing. I will show you. If you take a long view chart, here these are all the UK sovereign debt yield curve, all the maturities from 1 year to up to 30 years. You can see what is this bar up, the jump that it has been happening in the past couple of days. So it has been really interesting nevertheless. And this basically will mean a big deal for the treasury, because the geopolitical turmoil and the inflation problem will continue keep grinding and being a cause of headache for the Bank of England and the Exchequer. And I will tell you in a minute what this is going to mean for households and for eventually public finances, because when the cost of borrowing goes up, that will become an additional cost for servicing the debt, so more taxpayers' money will have to be allotted for servicing the debt. And for all the Brits who are in Britain, I'm really sorry. I'm really sympathetic to you all, but the every now and then, if inflation, something that you need to know is that something that I repeated over and over again is that when inflation is high, the UK, Britain is particularly weak, is particularly vulnerable, sensitive, or fragile to higher inflation when it comes to the cost of borrowing for the government. Why? Because the UK has this wonderful thing which is called, like many other countries, it has this wonderful thing which is inflation index that. And you can see that if you are an ordinary British person, you can see that the government issued 434 billion of indexed inflation gilts, and the total amount to pay, it has inflated to 694 billion and change. So this difference is exactly due to inflation, and you can read it here. Data on gilts in issue are updated after any gilts auction, as well as after the RPI has been published each month. So what the government does is to attract investors, is to borrow, to issue index-linked gilt, which is of a very long duration, way longer than 10 year, 20 year, 30 years. I will pay you in 2073, which is, I don't know, something like 47 years down the line, okay? So you can understand this part of the stock of outstanding debt. It explains in clear, with clear data, with factual facts, to the average person, whether you are in Edinburgh, in Birmingham, in Walsall, Swindon, I don't know, Portsmouth, wherever you are, Southend, North, East, West, Sunderland, Newcastle, Liverpool, Manchester, Leicester, wherever you are, take this data from the debt management office, and you will understand why investors, the global bond market, it has been hammering the Exchequer with not midnight hammer, but it has been asking for higher and higher yields, because a lot of money here, okay, we are almost close to 700 billion. They are managed by your geniuses in Whitehall and Horseguard and the H&M Treasury, etc., by issuing gilts, sovereign debt, which is index linked to retail price index. and you can appreciate their marvelous job in issuing 434 billion and change, but actually you will have to pay 700 billion. Oh, all taxpayers, they will have to pay 694 billion, and this premium keeps inflating, keeps going up and up and up. So what does it mean, all of this? Okay, if you are the average Brit, you work in wherever you work in Britain, or you work in Dubai, or you work in Europe, and somehow you'll have to pay a chunk of your profits to HMRC, you need to know, it's your right to know that a chunk of this money, it goes for the worst management of issuing sovereign debt that I've ever seen. It's second only to the United States, probably, although the United States, they can do whatever they want. And because it's indexed to the RPI, they are ripping you off, okay? They are really ripping you off. And there is nowhere near on the horizon that there is someone that is willing to sort it out. So here we go again. As Rachel approached the dispatch box, the chancellor, he was taking a chance to read a statement which was written for a world that does not exist anymore. Because of all the geopolitical turmoil, you can see how the cost of borrowing for Britain has skyrocketed, and it has experienced some very large volatility, which is double than the average European sovereign debt volatility. So if you go on, if we take the website here, and it's not made by me, it's an external website, it's clearly written in letters. UK 10-year gilt yield surged 4.5%, up 20 basis points, which is 0.2%, but it actually, from the end of February and the start of the Middle East operations, and so not for the Middle East operation, but the bulk of the thing is the huge spike in oil prices, gas prices, electricity prices, and so the inflation. So what the dynamic for you average British citizen who are in Birmingham, the dynamic is that because there is so much large amount which is borrowed in debt that is indexed to inflation, every time inflation data in the UK, they surprise on the upside, or there is a shock which is external to the country, which energy shock, then, and you see that the duration of this debt expires in 10, 20, 30, 40, 50 years, okay? Every time there is a shock on the inflation side, then the cost of borrowing, the bond market reacts in a brutal manner. So the cost of borrowing goes up, and here it's 4.22, 4.5, okay? So it's 28 basis points, okay? 20 basis points is the most conservative estimate, okay? But from bottom to top here, we are at 0.28% in a couple of days. The cost of borrowing going up, and that goes through then the mortgage rates, and it's 2022 all over again. The energy shock, although it's not that large, okay? This was the spike of UK natural gas in the market in August 2022, and was that high, okay? Now we are at here. So this is not only for the UK, because the cost of energy prices, they have increased anywhere. It can be France, Germany, Spain, Italy. Here the cost of electricity, for example, for Spain, in the past month, it has increased by 796%. So these are percentages which are out of this world, but the cost of the real cost of electricity for Spain is 56 euro for megawatt hour, okay? Because in Spain they are very clever, and they decided to to go for solar energy because they have plenty of sunshine all day. And if you live on the Spanish coast, on the Costa Brava, Costa del Sol, and you are a British expat, I hope you are enjoying, or I don't know, you are a tourist from anywhere in the world, you can enjoy a lot of sunshine, good food, good people, lovely people, good drinks, and somewhat cheap energy, affordable cost of energy. And here, UK cost of electricity, it has jumped to £110 per megawatt hour, which is second only to Italy, which is the worst of the worst of the worst of the worst for when it comes to energy and the cost of the cost of electricity. But you can see here that Germany, it's almost approaching the UK when it comes to the cost of energy. But here, these percentages, in a week, the cost of electricity, which is linked to gas, to the cost of gas in the market, it has jumped by 53%. So this inflationary shock, they are immediately priced into the market. Now, if we go to the part of energy, which is oil and gas, you can see the weekly change. UK gas, 94.5% increase in the price weekly in a week. The cost of gas has doubled in a week, and in Europe it's 80%. So these are really sizable price shocks that then the economy will have to absorb and will pass through to businesses and to households. So it's inevitable that it will be also heating oil, 33% up, 34% up in a week, and year to date, you see the cost of gas has doubled. Whether it's in Europe or in Britain, the cost of gas has doubled. The cost of gas for producing energy, so the cost of gas also for producing electricity, it has doubled. And this inevitably, as it's well known, it will pass through the utility bills and of households and of businesses. So it will become inflation, and it will show up in RPI. So it will show up here. RPI, it will show up here, and basically this amount will inflate with inflation. So if any British viewer, I hope that I have been exhaustive or complete and transparent in what is the real reason why the cost of borrowing for the exchequer is so high. It's because of mismanagement, but the idiosyncratic problem is this, that the government keeps borrowing, keeps issuing a part of that it's indexed to inflation, and it's linked to the highest data of inflation, because RPI it's always higher than CPI. So you are getting ripped off by the government, basically. That's, if you are a saver, you are basically getting a bit of saving. But I mean, I don't think this will change your life unless you have invested a sizable amount of money. That so you are a large creditor to the UK government. So what does it mean is that whenever this all energy price goes up, inflation goes up, the cost of servicing that inflates. Inflation uplift. So you are all uplifted by the next chancer who will take the chance to go to the dispatch box, read the statement, which lives in La La Land. It's a world that does not exist. It's a delusional fiction of theatrical characters who wander around like lost souls in the House of Commons, and they are in denial. So, it's for anybody to see. Open any website. I think anyone. It has paid a lot of attention to the stock market in these days, to what it has been happening globally, and you go and see how high is the cost of Brent now. It's $83 and change. The cost of WTI is $76 and change, and I don't know where it will go. But what do I know is that when there is a price shock, an inflationary shock, It takes time to pass through. So what you will hear from people is, no, don't worry, it's a one-off, it doesn't matter, everything is fine. No, it's not like that, because when there is a price shock, the price goes up, the price will go up, will stay there, and it will take time, a lot of time, months and years, eventually to adjust to what was the older price. And if you are an average consumer in Britain, you would know that since the 2022 shock, okay, it takes time for the market, it takes 1 year for the market to normalize, for example, the price of gas. But then, if the cost of living, okay, inflation, the cost of living for the average person, it takes even longer. You see what is the amount of months that it takes for inflation to decrease slowly. And inflation, it's a compounded cost. So every time we go out, we go to the chippy or the supermarket, we pay our bills, pay taxes, pay petrol, pay gas, pay whatever. Every time there is a transaction in the economy, there is the hidden tax, the stealth tax of inflation. So inflation, it's a compounded cost. We pay it every time we tap in, tap out, at every shop. You go to the coffee, Costa Coffee, Starbucks, wherever, the local. Even better, if you go to the local cafeteria, which is not a chain, large multinational. If you go to the local cafeteria, to the restaurant, whatever you want to do, there is a transaction involved, and so the cost of inflation is compounded for every transaction we have in the economy, whether we need to buy food, clothes, so forth and so on. And so what I hope the viewers of this video will understand is that the cost of inflation, first of all, it's compounded, okay? And I think this is very well known that the cost of living, it's an excruciating feature of living in Britain in the 21st century, and also living in America, or living in Australia, or in Europe. So we are at times of high inflation, and inflation is a structural problem. It's never a temporary thing. It's structural. It stays there for many months and months and months and months and months and months. And every day, tap your bank card, then tack, you are paying inflation. And so here we are in January 2026, everything was hunky-dory because RPI, it went from 4.2% to 3.8%. And that's also a delusional illusion, because January always has a seasonal effect on inflation. Every January bar, every year, it's negative, okay? But then the sequent, the following month, the sequential months after, they always have positive inflation data. So it's completely delusional, and the refusal of confronting pragmatically and scientifically the real problems, that everything was fine, RPI 3.8%. Now this inflationary cost will pass through, and there will be eventually down the line, in the second half of the year, RPI probably will stall, or eventually you would see that inflation surprise is on the upside. Why? Because this price shock in energy, this dislocation of prices in the energy market, will pass through businesses, will pass through households, utilities, and then it will become a larger component of the inflation measure. And so when they come up on the telly and say, okay, inflation, it's up again, and so will be the cost of borrowing, which has gone up. Inevitably, it has skyrocketed in the past, just this week, okay? This will be a huge headache. So what actually does it mean? If you want to eventually quantify, because at the end of the fanfare, what this will mean, not only the cost of utilities for or the cost of shopping for households and businesses will eventually have to absorb the energy market price shocks, so inflation. But because our geniuses in the black hole or white hole, they decided that the average breath will have to live with a long lasting debt linked to inflation down to 2073, something that I would never ever do. It's totally bonkers what these people are doing. It's totally bonkers. Okay, they should be stopped. Okay, these people, they should be taken, put in a straitjacket and neutralize them so that they cannot make any damage at all. So every time there is an inflation shock, this will be a huge problem, and so the amount will keep inflating, and the average British person will be forced to see more money going to servicing the debt rather than public services, because of this silly idea of issuing debt which is linked to inflation. Okay, so these people, they should be taken, which are in charge of managing the debt, or whoever works in the exchequer, the treasury, which is not the people who are on now, the people who came before, the people who will come after. They should be neutralized somehow, not to make any damage, because what the damage that they have created, it's already more than enough. Okay, because 700 billion. Okay, let's make a quick. I don't say this lightly. This may sound such a loaded loaded concept or offensive. I don't mean to be offensive, but okay. So 694 billion. It's 23, almost, let's say 24% of gross domestic product. Okay, because if we take 694.7 and we divide it by 3,000, okay, so 3,000 in billion, it's 3 trillion pound of gross domestic product. That's the size of the UK economy. It's 3 trillion pound. So the proportion, it's 24%. So this chunk of debt, it accounts for almost 24% of the total UK gross domestic product. And the average citizen in the UK will be saddled, will feel the burden of on their shoulders, going to work every day, come rain, come shine, every day. It's raining, it's cold, it's cloudy. They will feel the burden on their shoulders, and they will feel it on their hands, the pain in their bodies of doing hard work, up to 2073, 50 years down the line. This has to be stopped. I would never make it possible for some people to make such a disaster that millions, 60, 70 millions of citizens, which are innocent, yeah, they are hardworking people, they will feel the burden of this reckless mismanagement. Because up to 2073, whenever inflation goes up, the average working person will have to pay up for some reckless people who don't care at all about anybody, rather than taking £250,000 between wage and all sorts of amenities that they can enjoy. So I'm not in the position of doing anything, but I have to be straight, because this is wrong. This is totally wrong. And this is going to hurt public finances for many years to come. And it's not right that public finances, they are managed in with such naivety. And I can understand you tell me, oh, okay, but when I manage public finances, we need to issue debt that is linked to inflation, otherwise investors will not buy our debt. Okay, that it's reasonable. This is what happens anywhere in the world, because the United States, they have hundreds of billions of dollars which is linked to inflation. TIPS, Treasury Inflation Protected Securities. even Germany or France or Italy or any other major country, they have to issue sovereign debt which is indexed to inflation, but they don't expose their country to 24% of GDP, which is linked to any inflationary shock, especially if you are an island and you have to import everything. And so whenever inflation goes out of control, you are basically a lame duck, and ordinary people, they are going to feel the consequences. And even if you have the best of intentions and you are the best public servant in history, but you are basically pass through this immense misallocation of public of debt, of outstanding debt, then I don't know what you will be able to do. So basically, so if you want to allocate more money for ordinary people, to improve public services, you will not be able to do it, because the cost of borrowing keeps inflating whenever inflation surprises on the upside. And it's very evident that the gilts market has a structural problem with this. Let me take the main page of okay. You see here how 20-year gilts, 20-year, 30-year gilts, they are north of 5%. So the bond market, it's pushing a lot the long duration part of the yield curve. Why the when it's the 20-year, 25-year, 30-year, 40-year, 50-year, from 10-year upward, okay, the yield curve goes up. There is a marked steepening of the yield curve. You see, it breaks above 5% consistently, because investors, they are demanding that for such long duration in the future, whether it's 20, 30, 40 years, they want to be rewarded or protected from any inflationary shock. And here, 30 years, the latest yield is 5.17. 1 month ago was 5.3. 6 months ago was 5.5%. So mercifully, the cost of borrowing has decreased. But anytime there is an inflationary shock, the long duration, when it's 20, 30, 40 years, those bonds, they will be hammered into the market. And why? Because they are strictly linked to this. Because all the inflation part of debt issuance, it's all in the long grass. It's all 20, 30, 40 years. And so those debt securities are the ones that will be basically dumped into the market, because the bond investors, they will pretend that the yield curve adjusts, it adjusts to the inflation premium, whether it's 10, 20, 30 years down the line. So these mechanisms, this thing, it's very dangerous for public finances. And I wish it would be stopped immediately, because it's really, really dangerous. And again, for the same simple reason, whenever there is an inflationary shock, the gilts market goes haywire. There is no way bond investors, they would hold 30-year, 20-year gilt, 10-year gilt. They would sell it immediately. And this then causes other liquidity distress. And then there is the Bank of England, which has to do the repo market, and that is another thing in the back burner. But if we take this table, the long duration bonds, in the past 12 months, the cost of borrowing has increased. Okay, so the cost of borrowing compared to 12 months ago, still it's higher. It was decreasing, it was going in the right direction in the past 6 months or so, because in conjunction with the Bank of England cutting interest rate, then the yield curve adjusts down. The whole yield curve, the cost of borrowing shifts down, it moves down, okay? But compared to 12 months ago, when you check what is the 12-year, 15-year, the 20-year debt security, the 30, 40-year, still they are basis points, they are higher than 12 months ago. In percentages term, okay, it's a negative change. When this negative percentage, it's on the price. So the price goes down and the yield, it's higher. So these prices, basically, they are the zero coupon. So it's basically you take 100 and you divide by the yield and you will have the price of the zero coupon. So this is very, very, to me, it's really concerning. And another thing, whenever somebody is a government official and they say, okay, no, but the spread, it's narrowing. This is total disinformation. They are lying. They are deluded. They are delusional. Okay. The cost of borrowing for Greece, which is the bottom of credit rating, it's 3.5% for 10 years. The cost of borrowing for the UK is 4.46. It's almost 1% more. And the spread, here you have the table of the spread compared to the bond or the treasury, the 10-year bond or the 10-year treasury. The spread of the UK, so it's the additional cost of borrowing compared to the 10-year bond or to the 10-year treasury, it's 168 or 169 basis points, which is 1.69%, or 38 basis points, which is 0.38%. But the UK pays, it has an additional spread, which is higher than Vietnam, buddy. Yeah, higher than Vietnam, which is 153 basis points. UK pays 168. It's higher than Bulgaria, Malta, Malaysia, Greece, Lithuania, Italy, France, and down the line, higher than Canada, which is another Commonwealth country. Okay, Slovenia, Slovakia, Cyprus. Okay, Morocco, 3%, 10-year borrowing. Okay, so if I buy a 10-year bond from Morocco, it pays 3%. If I want to take a 10-year bond from the UK, it pays 4.46%, which is way higher. So it's better. But at the end of the day, the cost of borrowing, the spread, it's way higher than many countries in the G7, G10, and Morocco or Greece. Ireland, yeah, the next door neighbor, is 3%. And 4.46%, so it's 1.4% higher, the cost of borrowing. And this, by no chance, bond investors would be able to accept lower yields, because there is 20% of the whole debt compared to GDP is the bonds that are in the market, which are linked to inflation. So every time inflation, there is a shock in energy prices, supply chains, close the Strait of Hormuz, oil goes up, then bang, the yield curve goes haywire, because there are almost 700 billion pounds in the market in bonds which are linked to inflation. So for any dilly-dally mischiefs who goes on the telly and say, oh, but the spread, we have narrowed the spread, that is false. It's disinformation when it's made by government officials. This is like regime propaganda. You are lying. You are liars. You are liars. And it's bad, okay? The 10 years worse than Bulgaria, my friend. Malaysia. What are you talking about? How can you go on a straight face on the telly? Oh, the spread is fine. You're 170 basis points above the bond. And it's worse than Greece. What are you talking about? So, I mean, they should be straight and explain to the average person. Say, oh guys, the cost of borrowing for us is very high. We need to work all together to improve this thing. And they are so naive, they are so silly, because they pick and choose and pick and mix, and okay, no, you are black, you're white, you are this religion, the other religion. So they fracture the population, they put people against each other, and then those people who are in government, they keep doing disasters. And this is no way a country can survive all in one piece. I mean, people will start to be fed up. They will start to be. I really feel it. I understand. It makes myself very, very upset, very hungry, because this is not right. It's wrong. And by no means the UK is paying such a higher premium, even worse than Qatar. Okay, well, there is the little brackets here say, okay, Qatar, we cannot price it at the minute, but I mean, it's not the average yield. Okay, the average cost of borrowing for the UK should be 3.5%. Where is France or Italy or I don't know, where is Greece? Okay, if you give the UK 3.489% on a 10-year bond, they will take it, I believe, instead of paying 4.46. Okay, unless, I don't know, you have some problem with understanding simple percentages, but I mean, the cost of borrowing should be, okay, now it's updated, 4.5%. The cost of borrowing should be 1% lower. So if the market, bond investors, they are pricing this high yield, it means that they know that there is a problem in the bond market, and it's exactly linked to inflation, to the part of that it's pushed up by inflation over and over again all the time. And what then at the end of the day, when you have the yield curve that goes up, okay, now it's probably because I'm shouting and something it's going in the right direction. But when the cost of borrowing goes up and inflation it starts to be a bit not a bit. There is a price shock somewhere, energy shock, as I've repeated over and over again. Then what that does it mean for public finances? It means that then the exchequer will have to allocate more money for servicing the debt. And if from here, if we want to quantify down the line for the following fiscal year, what is going to be the additional inflation premium and how higher could result to be RPI, and what is the additional inflation risk premium that it has to be priced in the gilts market, in bonds, for the yield, okay, the interest rate on the bonds, when in the next weeks and months, bond investors, as they already have discounted the price shock, but where the level of the yield curve will settle, it will be at a higher level from where it was just the past week, 1 week ago, right? And so when you have to factor in the higher interest rate in the bond market, what then becomes down the line, the dandelions and the daffodils for the Countess of Wolverhampton, right? So Lady Daffodils, the Countess of Wolverhampton. So what then becomes down the line for HMRC, for the exchequer, they will see that the part of the fiscal purse that goes to servicing the debt, which is already more than 100 billion, it will become heavier. And that is the risk, that you are budgeting for some hunky-dory stuff, and then energy prices go the other direction. Again, inflation moves up, you have a structural shock goes through interest rate, the yield curves shifts up, it passes through the cost of borrowing, it passes through the economy, utility, households, business, cost of production, producer price index, retail price index, CPI, and then you have to basically think again on how you're going to balance the thing, because then any person, any minister who is a finance minister, which is, I don't know, wherever it is, in Romania, Bulgaria, Greece, any country in the United States, when they have an interest rate shock, then they will see that the cost of the amount that they have to put up for servicing the debt, it goes up, okay, it inflates. But the UK is vulnerable to inflation because of very bad choices, really unbelievable stuff. It has been going on for decades. Okay, this is not something that I discovered today. It's like I've discovered wildfire. Okay, 694 billion pounds. They are issued in decades, and the longest duration is by 2073. So it's really to the never. So for how long the British people, they will have to pay this inflation risk premium for the government to borrow and do their silly things? And then they go out and, oh, can you vote for me? No, fuck off. Really, honestly. Go get lost. I mean, why they should do that? It's not acceptable by any mean, by any standard. I mean, no, really. I mean, this should not be my concern, because it should not be my problem. But it's so macroscopic, this thing, that eventually, if someday we wake up and say, okay, there is a bond market crisis in the gilts market, yeah, at least you will know why. Perhaps in 2022 there was a bond market crisis, because all the 10-year, 20-year, 30-year gilts, every time they get hammered into the market, they are dumped. Okay, investors, they bet short, they short the bonds, and they make money. They don't give a damn. They short the bonds because they know it's money, sure, made. Lock, stock, and barrel. they are merciless. And yet the government, it does not learn. And they keep issuing, they keep feeding this mechanism, which allow investors for shorting the bonds, shorting the 10-year, the 20-year, the 30-year. They go short and they make money. And they keep issuing that which is 20, 30, 40 years down the line, because they do not want to be accountable for balancing a budget. When it's the chancellor today, yesterday, or the chancellor who goes to the dispatch box by the next chance, or the chancellor that take a chance 10 years ago, 15 years ago, they all took a chance. And see where that's got now, where are now the public finances, and what heavy work ordinary people have to do to balance the things. So I'm gonna cut to the chase, and I'm gonna give you the numbers, because I've been I've been shouting from my desk for quite some time, and I don't matter if you am I even bothered? if you're not bothered, it doesn't matter. To me, it does matter. But so we cut to the chase, and I'm gonna give you the numbers of what does it mean? Okay, this old pantomime of the higher cost of borrowing. So, quick calculation. We know that RPI was 3.8% in January, but this the January, it's a seasonal effect. So every bar, every year, January 2024 negative, January 2023 negative, January 2022 negative, January 2021 negative, January 2019, January 2017. So every given year, each and every year, the month-on-month inflation CPI number, it's negative, but in January only, and always in January. So January 2026 was no different from all the past years since the dawn of time. And then you can see month on month after month how then the inflation basket numbers, they come in positive. Can be 0.1, 0.2, 0.3, but that is a compounded cost all year. And it's compounded in the yearly inflation rate. Okay, so we knew that RPI was 3.8%. Now, by trying to factor in, not in a precise manner, because I'm only writing on a whiteboard, so I haven't modeled precisely the pass-through shock of inflation. So RPI, it can move up by 0.5%, okay, to even 1.5%. Okay, so you are contemplating something in the range of plus 4% RPI again. Okay, the worst case scenario is that the energy shock pass-through it's way more chunky and consistent. So it's north of 1%. And so when the inflation, the RPI measure, then what that means? It means that we are getting ripped off by the geniuses in Whitehall. Okay? Because this singularity is gonna go diverge to infinity, and that becomes a black hole, right? It's very, very simple. Every time RPI goes up, the ordinary British folk is getting ripped off. By who? By the government. There is no if, no buts, no whatsoever we are talking about, because this is unconfutable, undisputable, right? So, energy shock, RPI today is 3.8, last month was 3.8 on a year-on-year basis. The pass-through shock of energy, it can be as small as half a percentage point. In the worst case scenario, it's 1.5. But anyway, there is the risk that RPI, it could print out not next month, but in spring or summer, when this energy shock goes through, it prints again above 5%. And then the Bank of England is stuck because they cannot cut interest rate by any stretch of any imagination. Even if you spend 10 hours a day in the gym doing stretching, the Bank of England would be really stuck again in the same situation. And so what this means is that the 10-year, where is it? Why is it? Okay. So this one, okay, the 10-year cost of borrowing, already it has jumped by 20 basis points, so plus 0.2%. 20 basis points, 0.20%. Okay. So I don't know how to squeeze together in the same thing both stuff. Okay. So the 10-year cost of borrowing, it has jacked up already 0.2%. I'm really crap at writing this thing, but I'm using a mouse. Okay. Oh dear, this is not cute. Okay, 0.2%. But with the risk of this inflation premium, RPI going up north of 4%, this will add again an additional 35 to 50 basis points. Okay, so 20 basis points already have been priced in, 0.20%. What that means is that when the inflationary shock passes through, the yield, the cost of borrowing, can increase by in a range 0.35 to half 0.5%. Okay, that's the inflation risk premium that the bond market will price into the interest rate. Okay, so immediately when the whole jets and stuff went on, already the market, boom, price goes up, the yield goes up, and these are from bottom to top, 4.22 to 4.5%, it's 28 basis points. My estimate, which are written on a whiteboard, and I have not modeled precisely because I need to take the data, is that the whole dislocation will be in this range. So if the yield now is 4.4, we are talking about 4.75, 4.9%. 10-year interest rate. Okay, so this bit here, or this one, can go way higher than this. It can go back to this level, 4.7%. Or if it breaks above 4.5%, it means that it has basically the market, bond investors, they see that the inflationary shock is going to be sustained for months ahead. And so it's very easy that the cost of borrowing will breach above 4.5%. But this is not only a UK thing, because I want to show you something which is very simple but very, very important. Whenever, here we have the chart of the 10-year treasury. The 10-year treasury yield, it does not budge below 4%. There is no way. You see, it's bouncing against 3.95, 4%. It has been bouncing here for quite some time. This is not a good sign, because bond investors for the treasury market, the treasury market, they say, no way you're going to pay me less than 4% for a 10-year treasury note. And I think that even if the Federal Reserve will cut interest rate, will try to reduce the Fed fund rate, of course the 10-year treasury will have to be priced below 4%. But what matters to me, what is important for me, is that bond investors, you see that the 10-year treasury keeps bouncing at 3.95 or something, at 4%, and it bounce up, bounce back up. Because bond investors, they would not accept less than 4% year or a 10-year treasury. So they are discounting way ahead 4% every year for 10 years. So they are discounting they will not discount the coupon cash flow for less than 10%. And this is not a good sign, not only because of inflation or inflation expectation, it also because of public finances, because the United States public debt, it's increasing, it's expanding, it's going, I don't know what is 36, 37, 38 trillion dollars. So the size of the United States public debt, it's so large that bond investors say, okay, no, there is no way we are going to take a 10-year treasury bond auction for less than 4% coupon. It won't work, because to have some money waiting for 10 years, of course they will need an interest rate which is able to absorb the whole volatility of inflation year on year. So at least to preserve the purchasing power of the dollar that it's invest in a treasury, US treasury. So the UK is not alone in this situation, because also the Americans, the 10-year treasury keeps bouncing again it keeps bouncing on the 4% line, and it doesn't go below that. So bond investors, they can't hear a thing. They won't take it. And this is also a sign of pricing fiscal deficit and all that kind of stuff. Okay, so when we go back, the additional risk premia, inflation risk premia for the 10-year gilt, it can be in between 0.35 and 0.5%. Considering that 0.2%, it has been priced already into the market. Okay, so I made a mistake. I had to be more precise. Okay, actually, it's not so dramatic. I made a mistake. Okay, so we have priced 20 basis points. So to get to 0.35, we need to add up another 15 basis points. So okay, so it's 4.5. Okay, 4.55, let's say. And okay, another 470. Okay, 475. Yeah, exactly. Okay, so what I'm saying is that the yield is here, and it has priced in come on, okay, we have priced in 20 basis points higher. When this energy shock will pass through, will become a feature in the economy, so there will be higher bills, higher energy bills, so forth and so on, and RPI will tick up again. So this 10-year yield can go as high as 4.5%, 4.7%. So there is the risk. What that means in real number is that there is a risk down the line in months ahead that the 10-year bond interest rate for the UK cost of borrowing will not be 4.4%, but will go up again, 4.5%, 4.7%, because the global energy shock will be priced in, and then the yield curve, the interest rate, will have to adjust to a rising inflationary picture. and that is the real risk. And so when this cost of borrowing will move up to 4.5, 4.6, 4.7%, that means that the cost of servicing the debt will increase. So more money will have to be spent for servicing the debt. This is what actually means in real terms a rising inflation and a rising level of interest rate, which is priced in the bond market. And I don't want to go nowhere near mortgages and stuff like that, because it's definitely, I mean, I don't have time, and I cannot price it. I mean, I don't work in a bank, so I cannot price it. So in real terms, oh my God, we have lost Houston. We got a problem. I lost the window. Yeah, so in real terms, if and when the yield on the 10-year, or basically the inflation risk premium for the whole yield curve, will eventually be priced higher by 0.35, 0.5%. For the fiscal side of things, what it means is that there will be an additional somewhat 12.5 to 20 billion pound, okay, in cost of servicing the debt. So the part of the public finances which is payables towards servicing the debt interest in public finances could expand by 10 to 20 billion pounds. So the cost of servicing the debt would be 12.5 to 20 billion pounds. If this scenario would materialize, okay, so the cost of borrowing is already higher, 0.2%. If keeps going higher, because RPI from 3.8 will go again to 4% or somewhere around 4% or higher than 4%, then bond investors, of course, if RPI is 4% or plus 4%, of course the 10-year gilt will be 4.5 or 4.75. And this will become an additional cost of 12 to 20 billion sterling in public finances for servicing the cost of debt, which inflates with inflation. So that's what actually would be the consequences of a prolonged inflationary shock in the economy, but precisely for the yield curve and public finances. So if this puppet goes to 4.5, 4.7, because then inflation starts to be 4% or something like that, then the exchequer will have to spend more money for servicing the debt. And of course that will change all the budget planning. So they will have to basically think carefully on how to balance the budget. Okay, that would be eventually the consequence. Something that it has been already was a feature of the energy shock back in 2022. So I have to love you and leave you, and I'm sorry if I shouted and I've been so a nasty person, but eventually I'm trying to anticipate what can eventually be the distress for public, eventually what it will become the distress of public finances because of inflation and higher interest rate. And by no means, I just done some quick numbers, running some quick numbers, but I will hope to do some more modeling and see what comes out of that. But anyway, have a good day and enjoy your time, and